morning. It's a fresh week. It's the last week of September. And wow, I am amazed at what is happening and continues to happen. So I'm so glad to share and offer some ideas on what I believe are 8 inflation-proof investments worth considering. As I've been teasing you on the screen, I want to talk a bit about what I've created, I think, a term called crisis inflation. I've searched the public records. I see nobody talking about this, but it seems to me many of the items we are buying are being increased because all the companies in that sector, because of all the problems popping up here and there, can feel they can raise prices. See, many times companies are price sensitive. It's called in economics price leadership. If one gas station raises prices, another one raises prices. If one comes down, the other one goes down. You probably noticed that at gasoline stations more than ever. But now with restaurants and other people with supply chain issues are all saying they can raise their prices and not worry about the competition lowering their prices. I'm calling that crisis inflation. I believe it's the first time it's ever been heard. I know it's the first time I've ever used it, but I thought about it and said, that's what it is. It's the crises that we're handling, everything from excess government spending, influx of immigrants, inflation rising at a faster pace than we ever believed would happen. All this economic activity of operating after coronavirus has kind of been weaned down, is causing a problem. So what I thought I would do today is just share some of the better ideas I feel will cause you to hopefully find the safe way to use investing, not just real estate. The world of wealth in Wayne's world is not just real estate. There are other investments out there. I feel, and I'll say it again today and show it again today, real estate to me is the ideal investment because it brings 5 factors no other investments bring. And so all these 8 suggestions are definitely inflation safe. And in fact, even though there's no guarantee when it comes to investing for inflation, I know I found something that I believe for the first time is really a winner for you. It's got a couple of drawbacks, but they're not really drawbacks if you consider we're in this for the long haul. I-bonds. I teased you in my flyer and my promotions that I-bonds right now through October this year will earn you 9.62% on an annual rate for the first 6 months. So if you buy I-bonds on October 1st, you've got 6 months of 9.62%. That to me is a powerful concept that probably has never been seen in a long time by people. Just looking at a guaranteed government investment of 9.62% has to make you think about, hey, maybe this is where I should put my money. Now, a couple of caveats. One of which is, again, it's an I bond. It's no other kind of bond. It's got to be an I bond. Albert Einstein happens to be in one of the pictures of the many I bonds that are issued. Also, you have to realize that I bonds, by their nature, have certain characteristics. I stands for inflation. They're exempt from state and local taxes. Their rates are calculated every 6 months. So you'll get 9.62 for the next 6 months, and then it's tied to inflation for the next 6 months. And that's the first caveat, because you have to hold it for at least 1 year. But as we look at the projections from the Fed, it doesn't look like inflation is going to go down drastically. I mean, what if only you receive 5.2% the next 6 months? That average is over 7% guaranteed by the government. And it could stay higher, it could go lower. But even if it goes down, if inflation goes down to 1% in 6 months, and you get a 1% rate, you still averaged over 5. Safe investment, $10,000 minimum investment. There are actually some people looking at saying maybe it's worth borrowing at a low rate or moving some money from some other accounts that were paying you low rates. See, the key right now, and we'll see this later, my friends, is short-term investing. The 2-3 year CDs at 3% or so, tempting you. But again, the economists, the money managers are looking at short-term investments. Some of the money managers are buying broker CDs for a week at a time. Now, we can't buy those as they can because they're broker CDs. They're safe, but see, these iSavings bonds are safe. This is a powerful process, fully backed by the U.S. government. Now, again, anything can happen, but I don't think it's going to happen. Never happened before, probably never happened, never will happen again. So with the concept of looking at these in some detail, it's a variable rate. It's got a lot of potential. And what it does for you is give you really a nice way to earn. I mean, if we stay at 9% for a year, that's $962 on the $10,000 investment. So again, you can purchase them through the end of October at a guaranteed 9.62% for the first 6 months. It'll adjust itself again based on inflation the next 6 months. So early spring, you'll see another 6 months. After that, there are some penalties. It's minor. If you cash out before 5 years, you lose the last 3 months of interest. At 9.62, I don't see a problem. And anything lower, I don't see even a bigger problem. So I would suggest strongly that in Wayne's world, if you do what I'm going to do, is buy a $10,000 I bond and get my 9.62 and hope that I will see a good return. Even if inflation comes down, I'm still going to be protected. Again, I have rarely ever felt as good about a government investment as I do now. Even the tips we talked about over the past several weeks, if you've been with me, the Treasury inflation protected securities, aren't nearly as good as this opportunity is. Secondly, after you've done that, keep some cash in money market funds. And there's 2 reasons why that's true, as you can see. Rates, money market accounts fluctuate. That's true. But they adjust upward as interest rates rise. We are in a rising interest rate market. There's no need to purchase higher yielding cash type investments. I think when inflation hits, and it has, and maybe I should have mentioned this before, money market funds are interest-bearing investments, and that's where you need to have your cash parked. And they're short term. And money markets rise with the general market, so you shouldn't face loss of market value that plagues fixed rate investments during times of inflation. Again, short-term, flexible rates tend to be good. It's a question of when. Some of the highest money market rates today are at Ally and CIT Bank. Many of these are online banks. Byline is paying 2.2%. I have Byline in Illinois, 2.2% on their money market funds. And all have different balance tiers, and almost none have any kind of minimum balances or monthly maintenance fees. Sometimes they'll have a minimum of $100 deposit, but that's minimal. These are very easy to get into at a very low price, and they don't charge monthly fees. The challenge or strategy still means that you technically are losing money in inflation because, again, nothing has to be valuable if it's not at least 8%. That's why we go back to the I bonds. For at least 6 months, you will be ahead of inflation. There are very few ways that you can have short-term money coming to you that will beat inflation in the next 6 months with minimal, if no risk, considering it's federal government insured and backed. But these are the 2 main reasons why that seems to be a valuable way of looking at investing. But see, even the money market fund is better than leaving it in your checking account or savings account that is still at 0.3, 0.7, whatever the numbers are. Unless you're fortunate to have a bank that's got you at 1. But even that is going to go up by at least 100% if you get a 2.2 at a bank like Byline. Or look at Allies Rates or CIT banks or many other local banks or many online banks. Once again, some people fear online banks. Discover's an online bank. They're FDIC insured. If their rate is high and you have less than 250,000, you have the same guarantees as any bricks and mortar bank you walk into and bank at. And once again, the other option is credit unions. They're not FDIC insured, they're CUNA insured. Their credit union has a similar system to the FDIC. But these are some powerful reasons why you might want to look seriously at money market funds as a way to do things. They're a secret weapon, and you should be adding them to your portfolio for short-term interest rates right now, and there's loads of them. My gosh, some of the major companies have several, sometimes 10, 20 different money market funds with different kind of objectives. And if you've watched the mutual fund market, you know how big some of the companies like Fidelity are and other ones in the process. But it is kind of like a nice secret weapon right now. So I'm guessing if you're listening, you got to be excited about these 2 points, the I bonds and short-term money market funds as a way to be safe during this time when you've got to be concerned about trying to keep up with and winflation versus inflation. Now, savings account versus money market fund. Well, very simple. Money markets, higher interest, minimum balance, and the banks are investing in short-term, highly liquid, low-risk assets. You can go online and find comparisons if you feel you want to look at this. But boy, it's a better way to be at the safest way of putting money aside rather than keeping at a lower interest rate savings account or even worse, a checking account. So I would encourage you to look at money market accounts and money market funds. There's 3 of them. 1 are based on treasury and government funds, very secure. There's prime money funds, and there's tax-exempt municipal funds. Now, again, this is not something to just go into quickly. The I bond, I think a quick decision can't hurt. I'm making a quick decision. 9.62, I can't say no. I can't say no. But if you're going to get into tax exempts, you want to talk to a tax advisor. Is that best for you? A lot of people love tax exempts. That's why the I bonds are nice, because they're state and local tax exempt. But these are the 3 major types of money market funds. You need to decide if you want to learn more. Just Google those different 3 and you'll get some information to help you make a better decision. In Wayne's world, the more information you have about investments, the better the decisions you can make. That's true of anything we talk about. The more information you have, the better the decision you can make. Information is valuable. It doesn't have any power until you use it. Just like knowledge is not power. Loads of people know a lot of stuff, but they never use it. So a quick primer on money market funds. Now, here we are, my favorite. Yes, inflation is usually kind to real estate. Historically, we start to see some of the huge benefits of real estate as a hard asset in the process. It's actually the ultimate hard asset. That's why I call it the ideal investment. Over the past several weeks, I think it was last week, we talked about gold, silver, diamonds, real estate, and tips as good investments to use during an inflationary period. Again, you watch the gold market, you watch the silver market, you watch the platinum market, but more expensive, and you watch the tips, but also food storage I talked about a little bit before. But most in all, real estate is my major way to inflation. It's actually the ultimate hard asset and sees its greatest price appreciations. So those of you who can find something, and again, don't worry about the interest rates. We're looking at 6% numbers. Don't worry about interest rates. Borrow as much as you can, pay it off as fast as you can, and leverage the investment and buy another investment. But we know the power of rents rising. We have rent wars in some markets. People are bidding up what it's going to cost them to move into a rental unit, like we've had bidding wars and multiple offers on homes. We're having multiple offers on, I want to rent your place. I'll give you more than what you're asking. Rent to own options, tremendous tool for you to use as you rent to people with higher rates. And again, you get a lot of benefits. Again, we're back to the ideal investment. And again, if you, for some reason, don't like to own the real estate, don't want the headaches, don't want the problems, REITs, real estate investment trusts, are fine. We also have these various crowdfunding sites. And if you've never heard of a crowdfunding site, take a moment, maybe today, maybe later on tomorrow, or sometime during the week, and take a look at what a crowdfunding site does. There are three major ones that are out there that get high ratings. Fundrise gets one of the highest ratings. Fundrise, Fundrise. Another one called Realty Mogul gets a high rating. Fundrise, minimum investment $10. Realty Mogul, minimum investment $5,000. Streetwise, Streitwise, Streetwise gets a good rating, $5,000. So the best one for the cheapest price right now to look at might be Fundrise. They also have a low fee to run the business, 1% versus 2% at some of the other places. So all those factors add to make something of benefit. But crowdfunding sites let you invest in income generating real estate, and you don't have to physically have the ownership. I love the ownership. I like the feel of the asset. I like those kind of things that go on. With options like Fundrise, they pay quarterly dividends. So you're getting some money every quarter. So you've got some income coming in. It's not monthly like a rental income, but at least quarterly. There's also an individual platform if you want to invest in individual properties called Roofstock, Roofstock. But again, the real estate investment trusts are Chicago native Sam Zell, who many of you know, became a billionaire with all his investments starting out in mobile home parks. Invest in large apartment complexes. They're in New York, Boston, San Francisco. There's a number of companies that do those things. But again, real estate should have a strong place in your portfolio always, but definitely right now, anticipating rising inflations. Every realtor I speak to, every seminar I do somehow comes out with this concept in Wayne's World. You should be buying at least 2 income producing properties for your own benefit. The National Association of Realtors just announced in the first 6 months, only 8% of the agents did more than 3 deals. 8% of 1.5 plus million members only did 3 deals. If you would have bought 2 for yourself and did 2 more in 6 months at a market like is unbelievable, you would have been in the top 8% of realtors this year. And what a tremendous year. So I'm suggesting strongly you take a look at real estate one more time, because it's always usually been kind to real estate. We've got tax benefits. We've got equity appreciation. We'll see in a few moments. It's definitely a powerhouse of things you can do in your portfolio. And it's something you all know. You are realtors. If you believe in what you sell, you should be buying it. I do not want to buy a Mercedes from a guy who drives out in his BMW that wants to sell me one. Why is he driving a BMW and selling a Mercedes? Or why is he selling me BMWs and driving out in a Mercedes? Why is he driving out in a Ford and selling me a Chevy? I don't understand that. You've got to believe in what you sell. Some of the top insurance producing agents in the country own the most life insurance. I've done several seminars for insurance companies on sales training. I can take in most large insurance companies, the top 10 agents, and almost all of them have the top 10 amounts of life insurance in their own personal portfolios consistently. Why? Because they believe in what they sell. And here's real estate. Not the best investment, not the only investment, the ideal investment. Because you look at all the things we'll talk about, or you've learned someplace else, and tell me which one has all 5 of these. An income level, monthly preferably, depreciation, the magic, I call it the 9th wonder of the world. The 8th wonder is compound interest, if you know how to use it. I can write off an artificial expense without spending any money at the rate of 3.6% for residential properties building value, which means if I have $3 million of buildings, I can write off $108,000 of income earned from those buildings or any other income from selling real estate and pay no federal income taxes legally. Again, in Wayne's world, our focus is very simple. Avoid taxes like poison. That is legal. Evading taxes is where there are problems. Tax evasion strategies create jail time. Tax avoidance strategies build wealth. And money talks, but wealth whispers. You get an equity buildup. Every time you make a monthly payment on that loan you borrowed, you're reducing the principal. I can show you examples where tenants have bought me homes. They've been there 15 years. I took a 15-year mortgage out. They paid off the mortgage. They bought my house. And again, we get appreciation. Real estate is always a long-term valuable asset. And as we just said earlier, real estate is definitely reaping the benefits of inflation. Inflation is kind to real estate. And then the one that I think makes sense, I don't have to use my money. One of my 10 income commandments from a session several weeks ago was use opium. OPM. No vowels, not O-P-I-U-M, OPM, other people's money. And there's a lot of sources of other people's money. So there's your ideal investment. That should take that concept of I-bonds, money market funds, and real estate as 3 very strong strategies as we look at what could be a long term before we're out of this. Chairman Powell was just on a news show talking possibly 2 years. And as soon as he said that, there might be this long term before we're done, because they're going to have to let that balloon out slowly. We talked about a balloon blowing up too fast and inflating and breaking, and not letting it out too fast and causing a deep recession. That's the Fed's role. And that caused that stock market to go down to where we're getting close to what could be a bear market. I think on Friday, we were at 600 points away from a bear market as it's going down, down, down. Now, that's another whole issue for another seminar. But more importantly, real estate is the ideal investment at this point. But I sure can't say don't look at other things, especially the I-bonds. So if we're looking at this inflation, short-term investments are great. But again, my 4th way of helping you with a strategy is to avoid long-term fixed investments. The worst place to put money are in these 3, 5, 10-year CDs and other things that are fixed rate interest-bearing investments. And boy, if you want to look out that far at this point, not a good decision in Wayne's World. If you feel it fits your strategy, your portfolio, and you're happy with it, my goal is to help you make as much money as you can in passive income and enjoy it as long as you can. My focus and many of my colleagues in this world of wealth building in real estate, even though we have different strategies, we have the same tactic. And that is, look at real estate as that long-term investment and understand the power of inflation helping it. The problem with long-term investments is they basically have a problem because the value falls because there are other alternatives. See, without getting into the details, that 30-year corporate bond that's paying 3% could decline by 40% if interest rates rise. And somebody has a 30-year bond. They bought at 3%. If interest rates rise to 5%, they've lost 40% of the value. And that's why, again, short-term investments are definitely the place you should be looking at right now. Long-term investments are excellent when inflation and interest rates are falling. We're going in the opposite direction. I keep saying many times in my seminars, those who don't understand history are bound to repeat it. Again, we have historical perspectives as far as 40 years ago. Everybody's comparing us to the 79, 80, 81 era. Yes, because it's history. And what people did back then to get out of this in a positive way are the same things I would like to share that you do now. So again, inflation has taken off. You should have reacted to it much sooner, like many of us did, and get out of long-term fixed investments if you had them. And that's why I said we have several money managers that are looking at their investor portfolios and putting in one week CDs, 1 month CDs. Sometimes 1 month is long-term in some portfolios right now in the process. Now look where you've been. I'm looking at my time frame here, and I bet in the last 30 minutes, you could never have found a better way to find out 4 things that you should be doing that would make sense to do when you leave this seminar with me. Now, once again, these have to be your goals. You cannot do somebody else's goal. I'm giving you specifics that are obtainable, that you've written down, and they've got to be something you want in your world of wealth versus something I want for you. I would love you to do all these, and I wouldn't share them if I didn't think they were worth doing for myself. I have no long-term fixed income investments. I have a lot of real estate. I'm buying my I-bond today or tomorrow, as soon as I get to a bank. Oh, by the way, I can't even go to the bank to buy it. I didn't tell you that. I have to go to treasury.gov. I do this online. I buy the I-bond online. You can leave this seminar at noon, Chicago time, and go right to treasury.gov and buy your bond today and start earning 9.62% for the next 6 months. They're not sold at banks. They're sold only direct through the Treasury. Google I-bonds and you'll see that. People, this to me is probably the most important day I've spent online sharing some things I know will help you in the next year. And as maybe Chairman Powell says, more than a year, which kind of scares me. But again, wealth transfers from one group of people to another group of people in inflation. Somebody's going to make money. Hopefully it's you. In fact, I know it'll be you if you follow Wayne's World. And maybe not as much as somebody else, but as long as you're ahead of the game. I don't compare myself to anybody. Some people make more than me in a day. Some make less. Some make better investments. That's okay, as long as I reach my personal goals. Just like we talked about personal inflation rates last week. I don't care about headline inflation. I don't care about core inflation. I care about inflation in Wayne's World, how I spend my money. Short-term versus long-term, there's no question. It has to be. It has to be short-term right now. So, number 5, emphasize growth in equity investments. Now, this may be sounding funny or new or different from a person who's been preaching real estate, real estate, real estate. But again, we're in different times. We're in different times. But equity investments make a lot of sense because they make things happen. They could be anything from energy, food, healthcare, building materials, technology. These are the typical best type of growth stocks and funds and equity investments. So look at those if you want to. There are mutual funds available that have these as a package. Many of the large mutual fund providers have great portfolios that are specialized in these equity investments. And again, the 5 most powerful seem to be, well, you could tell building materials. We've watched what happened to lumber, technology, healthcare, food, and energy. The rest, I would suggest you take a look at, but those are the 5 I would concentrate on if I was looking at equity investments. And again, personally, I would probably go to a mutual fund because I don't want to keep watching all these. I'm not a person that watches the stocks every day. I'm not a day trader. That's a little bit risky for my mindset. But high dividend paying stocks are never really affected by rising inflation. It's the same as long-term bonds. So I'm giving you a lot of information to tease you. So all you got to do is leave here and say, oh, I'm going to search equity investments. And you'll find loads of articles, loads of material, loads of ideas in the process. We have the exchange-traded funds that you can get into extremely inexpensively. Ally has them, TD Ameritrade has them, Public has them. Those are top companies to look at, commission-free brokers to buy you exchange-traded funds, ETFs. Another word, boy, you're probably writing more down than you've written down in 1 hour, but it's going to make a big difference. You can watch this again and listen to it again if you need to after you're done. It's posted. But Ally Invest and TD Ameritrade are getting the 2 highest ratings. I'm not recommending those are the only ones. Public is a good one too. But they all have no minimum investments. They tend to have all kinds of other benefits. They charge very little per contract. And you need to find out more about them. And to tell you the truth, whether you believe it or don't believe it, all the 3 I mentioned will do crypto trades. You know, crypto is a crazy whole concept of working things out. Blockchain, cryptocurrency, NFTs, non-fungible tokens. Those are all words that still are driving people crazy. But my gosh, we're seeing real estate deals in crypto. We're seeing athletes take part of their salaries and bonuses in crypto. And some people have lost a lot of money in crypto, and some have made a lot of money in crypto. There's actually a real estate designation for cryptocurrency in buying real estate and selling real estate. So it's here to stay. NAR is looking at it in much more detail. Even some of their articles are worth reading. How NAR is looking at cryptocurrency. They've got a whole group of people researching and trying to see how that will affect the housing market. Interesting reading if you realize that we have something on the horizon that's probably not going to go away. So all I can say is this is another area that should be one of the, I feel, the top 8 things to conserve yourself with and look at. Equity investments. And there they are. The best alternative is to invest primarily in growth type stocks and funds. These are great sectors. Once again, mutual funds have these packaged as separate funds. That might be a great place to start and get some free information. You can get loads of free information on all these by just Googling a large money market mutual fund group. Many of them, Vanguard, Fidelity, they go on and on and on. And again, these six will probably, or these five will probably be better performers than other equity sectors right now. But again, things change. I understand that. Moving on. Again, the value stocks versus the growth stocks. These are companies that you might want to be looking at, especially the growth stocks. And you can see some of the Facebooks, a lot of our technology, Google, Zoom, Netflix, versus the value stocks, the major companies, but even Cisco and WebEx. So I just sharing some things to arouse your curiosity and have you maybe push yourself beyond your self-imposed barriers and say, I got to find out more about these growth stocks and these different kinds of things that happen. So with that said, I'm going to throw another one out there that may be a first for many of you to realize at a time like this, commodities tend to shine during periods of inflation. I've talked about it over the weeks as hard assets in Wayne's World. The gold, the silver, the diamonds, the real estate, the food storage. Those, the hard assets, because hard assets go up in value. Quick story. Go back and look at the history of hyperinflation in Germany. They actually have films and videos of people running from work with wheelbarrows of money to run down and buy things immediately so the prices wouldn't go up the next day. We have some people right now looking at Gas Buddy today and listening if gas is going up tomorrow and running to a station before it goes up to save 15, 20, 30 cents. Well, that's nothing compared to Germany's hyperinflation. They show videos of people running from work with wheelbarrows full of money, and some of the money would fly away and nobody would pick it up. There'd be all these wheelbarrows parked in front of a grocery store with piles of money on them. People run in and buy a bunch of stuff off the shelves and put it in their cart, then go out and they got to pay for this. And when they went outside to get their wheelbarrow full of money, guess what they found? All those wheelbarrows full of money had only the money sitting on the ground. People stole the wheelbarrow. They didn't want the money. The money was worthless. That is a powerful, true example of why holding on to cash during an inflation period of time, the valuable asset is a commodity. The hard assets. And if you have the ability to store things, we use a certain brand of body wash. And I saw a great sale at Boxed, which is one of those online sites, and I bought quite a bit of it. I had opened up a new pack of 2. They came in packs 2. I bought quite a few of them and stored them. I just realized as I opened that pack up, what I paid $1.79 for is now almost $6. I'm thinking of all the money I saved. I told you a few sessions ago how I bought 100 cans of Progresso soup at 99 cents. I rarely see it under $2. Rarely. And if it is, it's only certain kinds. Most of the time I got to pay $2.69 if I'm replacing that soup today. So food storage is another powerful commodity if you can store it in your home and have enough room. If you can't, you can't. But again, it can't be something that's perishable or is going to get bad because you've wasted. But precious metals, and we even have gold and silver accounts. They hold the gold for you. These exchange trading funds I talked about actually will hold gold, and you get like a passbook to how many ounces of gold you have, how many ounces of silver you have. Once again, loads of free material available online, loads of stuff available from companies that market this to you if you want to read about it. But commodities tend to shine during periods of inflation. There's no doubt about it. It always has been. It always will. And it's kind of a predictable hold that seems to make some sense right now. But once again, it's kind of a weird, risky thing most people don't know about. in a bit. So if you want to invest in commodities, recommend opening up a brokerage account in one of the top rated brokers. Don't do this online by yourself. Get some assistance. You need a partner in this that can explain to you what's going on. A top rated broker, and you can decide what you believe is a top rated broker. Because otherwise, I think this is too much of a gamble. Too much of a gamble. Schwab, Ameritrade, Vanguard, Fidelity. Once again, 4 sample portfolios without commissions. And you'll see the mix right now. A lot of equities, not a lot of fixed income. Some people even go higher with equities depending on age. So you can find all kinds of charts and comparisons. But these are the 4 major players that seem to have good. I'm guessing most of you have heard about all of those. And again, you need to decide with a broker what the best mix is for you. Should you be more heavily into U.S. equities and less into international? Should you get into maybe, depending on your age, more fixed income just in case? So all these factors are not simply make a decision. Don't throw a dart at one and say that's it. But these are the different funds that these different trading companies used as their best process. So if you look at this, TD Ameritrade has 25% of the equities value in Vanguard total stock market. So they're a fund investing in another fund's portfolio. That's why it's interesting when you deal with the top companies. You see something. I'm not saying you shouldn't look at other companies. All I'm suggesting is, why not look at the top? Why not look at the top real estate broker in your market if you want to buy or sell your house? We market ourselves that way. Well, why not look at the top brokers if you're going to be investing in various kinds of equity investments or any other investments for that case? These could be good forever, not just for this time in our lives, because we'll get through this. It'll all be over. It's a question of how long and how bad. Either way, the wealth's going to transfer. It'd rather be you and me than somebody else. You got to learn to be the transferee, not the transferor. So, number 7, we got to consider other alternative asset classes. There's a lot more than we've talked about so far. There's a lot more than we've talked about so far. So look at some things I just suggested. Investing in artwork companies like Masterworks, investing in wine like Vint and Vinivest, lending money to small businesses with companies like Mainvest. I'm helping people right now by putting out some of my monies into people that want to buy real estate. I have several realtor friends who finally said, I got to do this. I need some money. And I've now become a person that allows them to borrow money from me. I guess that's a real estate investment also. We have people getting into crowdfunding sites, as we talked about, REITs, as we talked about, farmland, Farm Together and Acre Trader are 2 good sources. We got a lot of different things. There's another one I didn't put up called Yield Street, YIELDSTREET. Wide range of funds. It starts at about $2,500. But again, you might have to use accredited investors to do the work for you. You can't do this yourself. You just can't go buy these like you can buy the treasuries or the I-bonds or other things along those lines. But talk to a loan provider. Talk to somebody to see what options are available. Paperwork could be more than you want to do. A lot of reasons why maybe this is still an idea. It may not be as valuable to all of you because maybe you don't feel comfortable investing in artwork. But people that invest in artwork and wine oftentimes have a nice display in their homes. Many of the wine sellers are not just wine that people drink. They're wine that they bought as an investment coupled with what they drink. And boy, when you talk to a wine connoisseur who's got a wine cellar in their home, and we see a lot of that in our luxury market. I'll be listing a property soon with a 3,200 bottle wine cellar. A lot of those wines are investments, as that seller showed me. This is one from this year, many of this, whatever it is. But I'm just suggesting the fact is that be concerned with those concepts. Again, our thought process is, as the Fed eventually eases its monetary policy. The problem is, Chairman Powell said 2 more increases this year, not even saying no to more increases next year, but projecting that this whole process might take a couple of years to get us to a normal state and not have to go through a bad recession. Here's some of those other crowdfunding sites. I know you've probably heard of Kickstarter, GoFundMe, maybe even contributed to somebody's GoFundMe page. But these are, Etsy is one another person heard from. But Fund My Pet, it's another, Crowdwise, WeFunder, Fundable, Rocket Hub. These are all ways that people are using during inflationary times. Again, you have to make your decisions based on doing your research. The more information you get about these different funds, the better the decision you can make. I'm not here to recommend a fund, but to recommend you research something like this and see if it fits into your guts gauge. Some people would never think of doing something with one of these funds. Other people can't wait, just like cryptocurrency. Some people hate it, some people love it. The last one, convert your adjustable rate debt to fixed rate debt. Common sense. Common sense. I don't know how we can avoid this one in talking about credit card rates. Those of you know that anybody who is paying a balance on a credit card has got some huge, huge problems as we go through the next several months, if not even a year in the process. I just looked at a credit card statement I received that if I pay the minimum payment on my current balance, I pay my balances in full. I recommend it's the only way you use credit cards, and use multiple credit cards and balance transfers if you don't have all the money. And move it to another one and get yourself up to 2 months by leapfrogging with credit cards, another whole seminar. But the bottom line is I've never paid interest on a credit card in my life. And I rarely pay an annual fee unless it's got some tremendous benefits. But I just used this card for quite a bit of remodeling on some income properties. I had some paintings, some carpets, some all kinds of stuff, wood floors to put in. So I put it on one card because of their rebate program. But if I just make the minimum payment and never use the card again, it's going to take me 60 years at the monthly payment to pay it off. Wow, that scares me. That scares me. So this is not actually an investment move. It's just common sense. I have to get into fixed rate debt. This is not a period where adjustable rates make sense. We had that problem in 2004, 5, and 6. I saw people leaving my apartments to go buy homes and get 1.67% as a starter rate. They were actually paying less in a monthly payment for a bigger place than they rented from me at the beginning. But then that's where the problem began, because over 17 periods after that, the Fed raised interest rates 25 basis points. So we had 4.25% increase in 17 meetings. Yet in just the meetings since March through December, we're going to be close, if not equal to the 4.25. And that's the problem that faces us today. This rapid, almost astronomical growth so fast with these increases. They really are trying to stop this. And they're blowing up this thing really fast. They just don't want it to break. But again, 3.75 increases the last 3 meetings, unheard of. So convert adjustable rate debt to fixed rate debt. And credit cards, other types of car loans, etc., are the key and impact the fact of what's out there. Bottom line, we don't know what the Fed's going to do. We don't know how the Fed's going to react, except we know it's going to react with at least 2 more rate increases. Maybe they'll be 0.5, maybe they'll be 0.25. But again, the stock market seemed to show their concern for this when we looked at the comments that Powell made a few days ago. Again, interest rates hopefully will eventually cause the market to settle by that time. For now, again, repositioning, refocusing, whatever you need to do is important. Finding a few changes from the 8 we discussed could make a huge difference. And again, I've shared with you what I feel are some of the wonderful investments that will perform well in inflationary environments, which looks like we'll be here for a while. And some will even thrive because we have runaway inflation. We have what I call crisis inflation. And I think I'm the first person to use that term. If not, I don't know anybody else that's used it yet. Last 2 secrets to success. Get started and don't quit. Don't wait. Don't do it tomorrow. There's 7 days in a week. One of them is not someday. You got to get started and you can't quit. And you know what? 12, 18, 24 months from now, if we ever meet, you're going to show me the benefits of getting started. And again, right now, it seems to me the best start could be that I bond at 9.62% for 6 months. So we started with this slide. I wanted to end with this slide. The way I want to look at it is very simple. It's a way for you to realize we're in a crisis, and I'm not saying a negative crisis, just it happens all so fast and all so quick. And again, you've got an opportunity that ends October 22nd. I don't want to know what November 1st is going to bring in I bonds. If they go up or they go down, why would I want to pass up 9.62 right now in the light of when nothing is even coming close to that in the process? With that said, I hope you found this to be the most valuable time we've spent that I've taken out of your life for an hour. And I hope that you do get started and don't quit. Look forward to seeing you next week in Wayne's World of Wealth. Have a great day. Enjoy some of the rest of the great seminars that we provide all week, finishing up with my partner and colleague in real estate, Michael LaFido, and the Lux Group in Luxury Marketing.